Okay, let's just get straight into the data today. Back in 2008, the global financial system was completely paralyzed. Millions of homes went into foreclosure, and the public watched in sheer panic as the institutions they trusted completely unraveled. But here's the thing. While the entire financial architecture was in free fall, a small, highly disciplined group of investors was actively writing the largest checks of their careers. They weren't gambling, and they certainly weren't guessing. They were executing a highly specific, documented playbook. It's an operating manual that has repeated itself in every major financial crisis for the last century. As an analyst looking at the data, the contrast is stark, and frankly, most people have absolutely no idea how it works.
To really grasp the scale of the devastation, you have to look at this number. In a single year, the S&P 500 lost 38.5%. US households saw $17 trillion in total wealth just completely wiped out. This wasn't your standard market correction. It was a systemic collapse that fundamentally altered the financial trajectory for millions of families. The sheer velocity of that wealth destruction left retail investors completely shell-shocked.
Yet, within this exact same time frame, we see a completely different reality for institutional capital. Warren Buffett made $3.7 billion, and he didn't make this money after the crisis had resolved. He made it during the absolute depths of the panic. This stark juxtaposition really forces us to re-examine everything we think we know about market crashes. How exactly does institutional capital extract billions of dollars in profit at the exact moment the public is losing everything?
Which brings us to an urgent question for today. Right now, in 2026, global markets are once again under immense pressure. Bitcoin has dropped 46% from its all-time high. The S&P 500 is facing intense headwinds. Macro uncertainty is spiking to levels we just haven't witnessed since 2008, and practically every financial headline you read is engineered to trigger fear. So I want you to hold this central question in your mind for the duration of this explainer. What is smart money doing right now, and are you positioned to do the exact same thing? By the end of this analysis, you'll have a precise, data-driven answer.
Section 1. Anatomy of a collapse. Let's trace the timeline for a second. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. At the time, it was the largest bankruptcy in American history, erasing $691 billion in assets literally overnight. Credit markets froze completely. Banks refused to lend to one another. Unemployment spiked to 10%, and consumer confidence essentially ceased to exist. Within weeks of that Lehman collapse, the broader equities market entered an absolute freefall. By March 2009, the S&P 500 hit a closing low of 676. And this brilliantly illustrates the true depth of the crisis. A staggering 56.8% peak-to-trough collapse from its 2007 highs. It was the largest drawdown since World War II. Faced with this data, the public did what the public always does. They sold. They panicked. Between October 2007 and March 2009, retail investors pulled hundreds of billions of dollars out of equity funds. They moved to cash. They retreated to the sidelines, just waiting for the headlines to tell them it was safe again.
But the fatal flaw in that retail strategy is mathematically clear. By the time the market feels safe, the opportunity is already gone. From that absolute bottom in March 2009, the S&P 500 returned 26.5% in the remainder of that year alone. And if we zoom out, the market returned a massive 17.8% annualized over the decade following March 2009. That matches or exceeds practically every other 10-year window in modern market history. The institutions that acted during the fear, not after it, captured every single percentage point of that wealth transfer.
Section 2. The institutional rotation.
We need to dismantle a popular myth right now. Mainstream financial narratives usually just tell you to buy the dip. But smart money does not buy everything indiscriminately during a crash. They execute a deliberate surgical rotation. Look at how this rotation actually played out in the hard data of 2008. Notice the stark divergence. While the S&P 500 fell 38.5%, gold held flat, closing the year around $870 per ounce, while stocks collapsed. That stability in a collapsing system is not an accident. Even more telling, US Treasuries actually gained 17%. This proves that capital doesn't just evaporate in a crisis, it relocates.
The crucial point here is that smart money operates with a strict three-part rotation strategy. First, they move into sovereign debt, like US Treasuries, because institutions managing hundreds of millions of dollars don't hold cash. They hold the highest quality sovereign debt available. Second, they rotate into hard assets like gold, which absolutely holds its ground when equities are being liquidated.
And third, they target dominant companies with resilient structural balance sheets that can survive the panic. Understanding this exact framework tells you where price support will exist when the rest of the market is plunging.
And by the way, holding flat was just the preparation phase, because as the Federal Reserve initiated quantitative easing and the dollar subsequently weakened, that same institutional capital rode the surge. Between the 2009 bottom and 2011, gold skyrocketed 166%. To put that into perspective, a $10,000 position established in gold at the start of 2008 would represent a 264% gain today. They positioned for the recovery by buying the ultimate hard asset when liquidity was drying up everywhere else.
Section 3. The Warren Buffett Framework.
The obvious question then becomes, how do you actually know when fear has peaked? Let's examine the ultimate documented case study of identifying maximum panic and executing with absolute precision. September 23, 2008, just 2 days after Goldman Sachs was forced to become a bank holding company. Consider the context. Lehman had collapsed. AIG had just required an $85 billion government bailout. Financial news networks were broadcasting what looked like a real-time apocalypse. The public was completely paralyzed. But then we see the calculated move. Warren Buffett's Berkshire Hathaway announces a $5 billion injection directly into Goldman Sachs.
Buffett wasn't just throwing darts at a stock chart here. He deployed a highly structured, risk-mitigated framework. He purchased $5 billion in special preferred shares that paid a guaranteed 10% annual dividend. This provided immense downside protection. But crucially, he also secured warrants to purchase additional common stock at fixed below-market prices, giving him uncapped upside. This is exactly how smart money operates. They identify irreplaceable franchises and they dictate preferential terms that retail investors simply cannot access.
Actually, this wasn't an isolated gamble. It was a systemic deployment of capital. In total, Buffett's cash commitment towards his crisis-era deals reached an astounding $14.5 billion. He executed this across Goldman Sachs, General Electric, and Bank of America, all at the precise moment of maximum widespread fear. By 2011, Goldman Sachs redeemed those shares, which is how Berkshire Hathaway secured that $3.7 billion profit on a single transaction in just 3 years.
This framework has remained completely consistent across every crisis Buffett has navigated since 1973. It relies on a ruthless, unyielding logic. Fear creates price dislocations. Price dislocations create asymmetric opportunities. And asymmetric opportunities strictly reward those who act with discipline, stripping emotion entirely out of the equation.
Section 4. The 2026 Market Parallels.
Now, the mechanics of 2008 aren't just historical artifacts. They are actively playing out in the market right now. We have to ask the question again, what is smart money doing right now in 2026? With global markets under intense pressure, macro uncertainty spiking, and retail investors once again paralyzed by fear, we don't even have to guess. We just have to look at the capital flows.
Notice how the exact same rotation strategy is executing in real time today. Despite Bitcoin being down 46%, ETF inflows returned with an absolute vengeance, seeing $560 million in a single day in February 2026. On-chain data proves large holders stopped selling after the $90,000 breakdown and aggressively began accumulating. Gold is steadily climbing as the premier macro hedge. Sovereign debt is once again attracting massive rotation capital away from risk assets. The playbook is identical. The asset classes are serving the exact same functions. Institutional capital is, right now, actively buying the fear.
The 2008 Playbook is a recurring operating manual for every financial downturn that will ever exist. The investors who internalize it are not lucky. They are aggressively prepared. The only variable here is whether you recognize the rotation happening right in front of you or if you're waiting for permission from the media. Remember the hardest data point of all. By the time the headlines tell you it is safe to invest, the window of asymmetric opportunity is already permanently closed. If this explainer gave you a sharper, data-driven lens to view market capital, make sure to subscribe to Fiscal Mind. Every analysis we do is built purely on data, never opinion. So, are you going to buy the fear or be paralyzed by it?